You will learn the most important capital shift happening in 2025, the migration from public equities to private credit. Now, where does billionaire capital go when the lights are off, when the headlines are loud, and when the public markets are a circus? That is, we will unpack why private credit is outperforming public markets and how you can start thinking like a sophisticated allocator. Real power plays are made here on this channel, so stay logged in. Let's start with the public markets. They are transparent, liquid, democratized, but they are also volatile, overcrowded, front-run by algorithms. And in 2025, the average investor is competing with supercomputers, front-loaded earnings trades, and central bank distortion. Meanwhile, public equities offer compressed yields, declining margins, no real influence unless you are an activist or own greater than 5%. Public markets are great for headlines. Private credit is where the real deals get done. So, what is private credit? It is when non-bank lenders like family offices, hedge funds, or institutions lend money directly to companies, projects, or assets. You are basically playing the role of a bank. Simple. Example, a $50 million bridge loan to a logistic company, a $10 million mezzanine loan on a hotel portfolio, a $100 million senior secured loan to a tech firm avoiding dilution. Why does this market exist? Well, because banks pulled back after 2008, regulations tightened, and borrowers still need capital fast. Enter the billionaire capital, where they step in with speed, flexibility, higher interest rates, and control over terms. It is alpha with structure, not chaos. Now let's talk billionaire psychology. The ultra wealthy don't need 10 experts. They want cash flow, capital preservation, collateral, and private credit gives them all of this. Yield with security. Billionaires are lending at 10 to 14%, often secured by real assets or cash flow. In contrast, S&P 500 dividend yield well under 2%. Negotiated power. They negotiate interest rate, covenant, equity kickers, priority liens. You can't negotiate with an Apple stock, can you? Zero headline risk. No public scrutiny. No volatility driven by retail. No exposure to activist chaos or Reddit mobs. Private credit happens quietly and off market. Crisis alpha. In downturns, public markets panic. Private credit holders restructure, seize control, seize asset, or get paid first. Equity is hope, credit is control. Let's look at the data. For my ongoing research as a hedge fund leader at Billionaire, high-grade portfolios saw minimal default. Private credit funds in 2023 to 24 returned 10 to 13% net. Meanwhile, public equities were volatile with net real returns under 5% after inflation. Add in covenant protections, asset backing, shorter durations, and suddenly private credit looks like high yield with a seat belt. So how do you enter the space? Well, you don't need $100 million. You need access and education. Start by exploring private credit funds with audited track records, syndicate or club deals that co-invest with institutions, real asset-backed debt, that is real estate, energy, infrastructure. Ask, what is the collateral? What are the terms? Who is the borrower? What is the risk-adjusted yield? You are not investing like a trader anymore. You are underwriting like a lender. Billionaires don't chase the crowd, they lend to it. In 2025, capital discipline wins and private credit is quietly becoming the wealth engine of the elite. High yield, low noise, deep control. It is not just where capital hides, it is where it multiplies silently. If this unlocks something for you, like, subscribe, and share it with someone who thinks like a capital allocator.